Yeah, this is about the psychology and sort of aftermarket impacts of M&A. So we've got this great panel, allow you guys to introduce yourselves and maybe just touch on your interaction with the M&A process. You guys have a sort of plethora of experience there, so go ahead.
So I'm Alex Kruger, CEO of First Reserve, which is a energy growth investor, effectively buy and build larger scale, later stage investments typically, and involved in kind of all ownership phases.
Gabe Wilcox, formerly co-founder and CEO of MineralSoft, which Blue Bear was our first institutional investor in our seed round, an investor again in our Series A round, and we exited December of last year to Drilling Info, now Enverus.
Hi, I'm Tanya Andrian. I'm Senior Vice President of Strategy at Enverus. And I do everything for our M&A, from vetting deals to working through diligence, and then manage the whole post-integration or post-acquisition integration process within our company. And in the last 3 years, we've done 13 acquisitions at this point, and MineralSoft was one that we did last December.
David Drescher, CEO of Mission Secure. I think I was invited. I've been in startups for the last 20 years. I've co-founded and built and exited from 2. I'm in the middle of my 3rd, sort of making down that path. I've invested in several. Some have been lucrative, some not so lucrative. And thanks for having me.
Awesome. Yeah, let's start with Gabe and Dave. I guess life. I guess leading up to and then post acquisition. Gabe, you're sort of still in that integration process, I assume. Dave, I'm sure you have some thoughts on how to both successfully integrate and also, I guess, keep the fire in your belly to keep on and try and start a new company. So I'd love to hear your thoughts first, Gabe.
So integration's a lot of work. I'll take a step back, though. We had, in my view, the really good fortune to exit to a company who we actually knew pretty well. We had partnered with Drilling Info, which is another thing Tanya does at Drilling Info, now Enverus. But we had worked together to get a partnership in place really a year and a half, ultimately, before the exit. Wasn't explicitly a prelude to an exit necessarily on either side, but it was a way for us to get to know each other really well. And so I think, as compared to the way it sometimes goes, where it's time for everybody to get out and you kind of run an auction, and you meet your new partner, new owner at the end of that process, this was a lot more comfortable, right, for us. So that gave us some comfort. That said, integration is still pretty tough. There's a lot to do, and I think this is my first time through it, Dave. But one thing I would take away from this year so far is that the employees of our company probably still have some fear and doubt about what it means for them going forward. No matter how well you deliver kind of the message of what the transaction's all about, and that it's still growth oriented and all that stuff. And so there's really nothing too small to potentially cause a ripple of fear in the company. So the one I keep coming back to is we use Slack as our sort of office messaging app. Drilling Info has had this Microsoft Teams license. They're pretty good parallel one-to-one there on what those things do. I thought, no brainer, let's cut the cost on that. People freaked. You would have thought that, the office was getting shut down. People freaked out, and so I won't take that lightly. And it made me appreciate that my perspective, having worked on the acquisition, known about it way in advance, seen it all the way through to the end. Other people just learned about it when we announced it and didn't have a good feel for what was going to come next. So that was something I took away.
Tell them you still have Slack.
And we still have Slack. They let us keep Slack. So they're actually also pretty good at integration because they realize what battles to fight.
So for me, it's starting a company's exciting, but then reality sets in pretty quickly, and you have to go find customers and investors. and it's a slog. It's not for everybody. It's a lot of hard work, but once you start to see traction and liftoff, it becomes really exciting. And most companies die in their first 5 years. So if you actually get to where you can have an exit, that's the exciting part, right? You can either keep growing it, take on more venture money, or seek an exit. My first company, I wanted to keep growing, but my investors had been in the company for 6 or 7 years, and they said, let's take the chips off the table. And so my job as CEO was, okay, let's find the best price and the best buyer, and did that. And then immediately after that, you realize that you just sold your baby. And the decision-making process in our case, a Fortune 500 company, was very slow and bureaucratic and involved lots of spreadsheets and things before I could just make a decision like that. And then all of a sudden I had people telling me how to run my business that really knew nothing about my business, but they were experts, but they were my new boss. So, integration was, I think, a bit rocky for us, but what I tried to do up to integration, and I've done everything since, and other companies, is you try to build a team around you, just like Lord Brown said, that is a great team, and so they don't need David Drescher, the CEO. So if you buy the company, I can leave the next day, and the rest of the team can come in and help run things and grow them and help the acquirer realize the value that they think they're going to get from the acquisition. So it was a real challenge the first time, and I see that a lot with startup CEOs when they sell and they call me and they're complaining. I was like, hey, this happens to everybody. So if you last 6 months, you're doing pretty well, even though they have a 2-year plan for you. I would say on average, the CEO probably lasts about 6 months or plus or minus. I think the companies know that as well, too. So.
Tanya and I are celebrating a 10-month anniversary.
Congratulations.
Yeah, well, speaking of acquirers, Tanya and Alex, you guys have, I guess, some might say, or some might know, different motivations for searching and targeting acquisitions. I guess I'm curious, two-part question. One is, what are the sort of, unintuitive frameworks that you use when you're searching for a target? And then, I guess, secondly, if the two of you were targeting the same company, how would you convince them to go with either First Reserve or Enverus?
You want to go first? I think on the first part, Vaughn, I think that, and Gabe hit on this, I think our alignment is a critical importance. And so for us, like Tanya, we're trying to cultivate relationships with management teams to really understand where they want to drive the business and whether there's clear strategic alignment around the way we think about the sector they're involved in, how we think about growth, and really trying to effectively corrupt any kind of process to maximize value and have the maximization of value really be about continuation of the path that a company's on. And so, we're looking for people who want to partner on the next phase of their growth before selling to Tanya or a strategic or someone else. And while we're a control investor, as typically the largest investor, management is still controlling the day-to-day ops. The CEO is still in charge, and they're executing upon that shared vision of the business. And so, for us, that's a really critical thing around who we're going to partner with and who we want to give capital to. And I think that's, a big thing we've been successful in lately is kind of succession management for transitions of management teams to the next generation, who wants their bite at the apple in a private context before becoming a corporate. And I would say that's kind of, one of the angles we're looking for to say, look, don't sell to a strategic just yet. On the next iteration, you should go do that.
Yeah, so a couple of different things there. How do we think about what we're going after and go target? Of the 13 deals we've done, actually 9 of them have been founder-owned businesses, and only 4 were through a banker-led process. So a lot of them, we are proactively reaching out to management and trying to work with them ahead of time or going with a specific intent of acquisition, or folks actually come to us as well too. And as we've been more acquisitive, we've also seen more of that where people are directly coming inbound. We really do try to think about build, buy, partner strategically and pursue all 3. And from when you're working with a founder especially, there's got to be a real story of 1 + 1 = 3. And that's how we have to, I know when I go meet with someone, I have to convince them to let me take the baby and that we're going to help the baby flourish and be able to create that vision and sell the story to them. If it's something more in a banker-led process where you're on third generation management, it's a little bit of a different feel to it. And that just becomes a lot more down than to the price and kind of what's the plan afterwards for execution. But the founder piece especially, it's really a lot about the vision.
Nice. So yeah, I guess, the other thing, the pitfalls question, right? Like I don't know, Gabe, sounds like everything worked out well for you, but I know that prior, some of my investments, acquisition processes have fallen through, or targets have eventually become less interesting than they were initially, for one reason or another. Would love to know sort of experiences across the panel about sort of either identifying those pitfalls, experiencing them, or how they've informed your processes after being exposed to them.
I can go ahead. I was thinking about this today, kind of what are some of the things we've experienced. When has a deal not really worked out? Obviously, there's times when you don't agree on the value and the price, and you part ways. Other things that we've seen, certainly technical diligence. We don't like to think of that. A lot of times we think, okay, we can rewrite. We're open to that. We're open to a lot of solving problems, but certainly there's been a couple things. One time we went in with a company, and they had on-prem installations, and every user was a Snowflake installation, not just at the corporate level. And so that was one where we said, oh, that's a little too much to take on. And then the other thing, we've actually backed out when there hasn't been a culture fit. And when we've gone in and seen a lot of I culture, or things that come across in those management meetings, that's actually been a big enough flag for us to say no.
With my version of success is selling the company, I guess we were saying, not having it fall through. So I run them all like a process. Just like making a sale, if you're a salesperson, you have to have a big pipeline because only 2 out of 10 may close. Right now I'm out raising a Series B, and I've got a list of 30 venture capital firms from Andreessen Horowitz to boutique firms in Austin, Texas. And selling, I think, for me, has always been a similar pattern in prior experiences where if you have multiple options, so I can either get a great term sheet from a firm I like and take that to the next level, but if I have a strategic who's willing to buy it with a good priced cash deal, not a lot of earnouts and funkiness, then that's also good. And then you just pick the best deal if you're in that position. If you're not, then then you've got your work cut out for you.
I think one point, and it's along kind of Gabe's point on integration. We also had just a bit of an integration onboarding and working with us in our systems, and we've really, as much as we front end load the strategic alignment, the ownership alignment post transaction, in terms of onboarding the team, the way we roll out to the organization to make sure there's a common understanding of what that vision is and what our expectations are, because just like. If you were to be acquired by Tanya, there's a certain integration into the broader system. There's certain reporting requirements, certain standards, certain changings of process and procedures as we're trying to improve the systems of the whole organization. So the 100-day planning for us is also really important, and I think that expectation level setting is important. I'd say one pitfall we ran into recently is we did a deal a while ago that we were consolidating 5 businesses because we're like platform buy and build kind of folks, and none of those businesses had we had an overall corporate head that was looking to execute upon the strategy, but none of those businesses had a really strong culture. And it resulted in there not being the cultural DNA to graft the other businesses onto, and it couldn't be CEO driven alone because those businesses were too established. Maybe not well established, but too established to really integrate a common culture, and that created just huge issues around executing of any of the plans. So it is the kind of you got to figure out where the strength is and how you graft the rest of the organization behind that.
One quick point, I think David made a good comment about running it like a process. I worked in finance prior to co-founding this company, and so I think I had a bit of that view on things as well when it came time to evaluate and execute the transaction. One thing that I know it can be sort of a buyer trick, right? Is let's drag the process out a little bit, learn a little bit more about the performance of the company as we go, and maybe actually even see what that distraction of a process alongside the operation of the business does to the performance. So now when I was on the other side of it, we communicated, I think, really clearly, we're interested, we'll be transparent about that, we want to explore this, but we got to do it in a hurry. We've got to do it in a super efficient way because my time, for better and for worse, the stage we were at as a company, my attention was not replaceable operationally. Other people who had to be involved in the process were not directly replaceable. So the business was going to suffer on some time scale. So we said it because we meant it. That is true. But we also said it because we wanted to run a fast process once we decided we wanted to close. So that's something that we were pretty focused on.
Cool. I'll do one more question, then I'll open it up for one or two from the audience. I guess this is more for Tanya and Alex. In our discussions, especially with investors as of late, the sort of Damocles of this impending recession seems to be hanging over each and every discussion one way or another. That combined with the sort of distortions that we've all seen in the private markets as well lately. Just wondering how that might inform, the next 18 to 24 months in terms of, your outlook, and are you waiting in the wings until things sort of start ducking underwater, or are you, trying to stay on process and, I guess, not just undistracted from macro circumstances?
I'd say in the more conventional business, things are definitely bobbing up and above water as it is already. So, the energy space, a lot of it on the upstream side is quite stressed. Capital formation is very challenging, and I think that your comments about the recession concerns. Obviously, there's concerns around energy. There's a lot of negative dialogue around traditional hydrocarbons as it is. A lot more focus than there has been for years, and now I think more broadly, cyclicals in the broader indices are coming under pressure. Lending availability, et cetera, is getting more challenging. So, that's one side. The other side is the space is a bit underloved, and so we're pretty active because there's not the capital availability, and we've seen returns move up pretty significantly. I think my observation for people in this room and around the growth side, where there has been a lot of interest in funding, I think the focus has to be on assuring that you have duration and runway, such that if that tap does dry up some, you've got running room to see your plans further through than you might have expected otherwise, to prepare for that potential.
Yeah, I wouldn't say we're slowing down, but certainly thinking about things a little bit differently. And with the energy sector, it is compounded by not just the threat of the recession, but because we already are in a kind of a stressed environment with lack of capital. And so thinking about making sure we're just really focused on where are the things that the oil and gas companies are still finding worthwhile investing in from a technology standpoint, and making sure we're staying ahead of the trends. If they're being focused more on cost efficiencies, what are we doing there? What's available? If it's more about cutting edge drilling technologies or optimizations, making sure we're focused there. So it's being more selective, I think, but certainly still active.
I was just going to say, I definitely agree with that. I think our focus has been on the more defensive side of the business, which we think of around cost cutting, efficiencies, all the things that people in this room have been talking about. No one cared about 5 years ago, and that is where the focus is. It's not on the latest shiny object. It's how do I save a penny everywhere I can.
I can just add to that. So we're out raising a Series B. We're funded for the next year. We've got $7 million of cash in the bank, but the board said 2020 might be, I think the term was a shit show, is what they used. So
It's a technical term, yeah.
Exactly, it's cyber term, and and so I'm out there raising money. So I think it's just being preemptive that we have that runway. If it does not turn out to be as pleasant as we'd like to see it in 2020, that we can continue and go through that.
Cool. Well, anybody want to chime in here? I'm sure there's Tim.
You mentioned that you passed on some companies based upon culture fit. Have you had an experience where you passed and they've done great? And if so, have you had second thoughts about
I don't think so. Like, I can't think of any off the top of my head because most of the ones where that has been a factor have been so recent that there hasn't been a track record. I will say part of this stems from a mistake I feel like we made where we did acquire a company several years ago and didn't take enough time around the culture piece, and we've been struggling with that internally since then. So it's been a little bit of a learned lesson.
Tanya, specifically. So, in Veris, or Drilling Info has done a good job of aggregating technology companies that have really strong brands, and then the entire rebranding recently is pretty fundamental. How is it going to shift the way that you think about maintaining brand and culture of your firm?
Yes. So for those of you that know Alan Gilmer, our founder, when we started doing more acquisitions, came up with the analogy of we don't want to look like a NASCAR going down the street with all these brands. So we did choose to rebrand, and it will bring more structure. As we were bringing companies into the fold, we hadn't decided ourselves, are we house of brands, are we co-brand, are we this or that? Now there is a plan, and I think we can execute on that better than we have in the past. So one of the interesting things with the rebrand, I don't think customers, it doesn't really matter to them quite so much, but internally, for our acquired companies, it has been huge. They've really adopted that very quickly into their vocabulary, and it's been great to bring the organization together.
All right. Ernst?
So we talk about different buyer groups, and obviously private equity is represented here, and our partners are from the private equity world, but that's sort of a mysterious creature to most of the Silicon Valley community. People think about selling to Facebook or Google. As founders, how do you think about that concept of selling to the next stage of a financial investor who maybe is now taking ownership for the first time, but is still not a forever investment?
Traditionally, I think of private equity, I think of big cash flow and EBITDA, right? So when they pay, buy it for 6 and sell it times 8 times EBITDA, that's usually the model. But I know we've been courted very early by the private equity community. As you know, Aaron, so we met with TPG, Blackstone. We had initial discussions. Macquarie is an investor in us and plans to participate in our next round. And so we're seeing the private equity community look at growth companies like ours, which don't have any EBITDA, and we lose a lot of money, and we're just trying to get top-line revenue. And I've seen successes. Blackstone had invested in a company, Cylance, and they threw huge amounts of money at it, and it was incredible, but they got a huge return out of it. So if I could see a path like that and have huge amounts of money thrown at Mission Secure, which is a global problem, a huge market, capture our share and get those kind of returns, that sounds pretty awesome. So I think it's just going to see how we as a company evolve and what the markets look like.
Might be one for you instead of me. I don't, we were a little bit early for that to really enter our thought process. It's a fair point that maybe the scope is widened for what the art of the possible is for different private equity funds, but we thought that we were early to explore a sale, frankly, actively, and so really only a strategic fit and a good strategic fit made sense for us.
You sold to one of your logical buyers.
Right.
Right. So.
Right.
Great. Anybody else want to chime in, or should we break for refreshments? All right, let's break for refreshments. Thanks, guys.